I'm Pat Soldano. I'm president of Family Enterprise USA. We really appreciate you joining us today for this webinar with MPI. Family Enterprise USA's sole purpose and mission is to promote family businesses and their job growth in the United States. If you are not a member of Family Enterprise USA, please go to our website. We need your voice. We have with us today Mark Lingerfield, who is with MPI, and we are very fortunate to have MPI as a sponsor of Family Enterprise USA. MPI is a national consulting firm serving both private and publicly held companies since 1939. Their value services broadly comprises corporate, transaction, advisory, financial reporting, litigation support, and tax-based applications. Mark Lingerfield is a managing director. He's also on the board of MPI. He's responsible for client services and business development strategies in the Mid-Atlantic region. Since joining NPI, Mark has determined the value of closely held securities of companies for a variety of purposes. As an example, gift, estate, and generation skipping, fairness opinions, purchase plans, buy-sell agreements, ownership succession, employee stock options, and many more. Mark has extensive experience in many industries, including professional sports franchises, beer and alcohol distributors, pharmaceutical manufacturers, newspaper companies, among others. Mark is also an expert witness and has performed that task. So we are, again, very fortunate to have Mark Lingerfield today, and he is going to talk to us about business valuations from estate planning to exit planning. Mark, I'm going to go ahead and let you start.
Okay, thank you, Pat. Just wanted to confirm, Pat, you can hear me okay?
We can hear you and we can see the slides.
All right, wonderful. All right, well, thank you, Pat, for having me today. I'm excited to share this presentation with the group. What I called this presentation today is business valuation from estate planning to exit planning. Now, sometimes we actually will do a third leg to that, where we actually are talking about startups and other things that early stage companies need to think about from a valuation perspective. Since I knew the crowd was more of established companies, we're gonna kind of skip some of the early stage issues, and we're gonna just move right to estate planning and then talk about some exit planning issues as well. I'm not going to get too technical today. If at any point you have a question, feel free to throw it into the chat. And obviously, I'd be happy to answer any specific questions that you may have at another time as well. My contact information is on this, and I will get this presentation to Pat, who I'm sure would be happy to forward this out to everybody. Okay. Let's move to the next slide. All right, so here's just some of the things we're going to talk about today. Just a quick intro of MPI, talk about some estate planning issues, what's going on at the IRS, some audit triggers. That's going to be an interesting slide. And then we'll get into exit planning, valuations, and finally, just generally how we work with our clients. All right, so just a little bit about MPI. I'm not going to go through all this, but this firm has been in business since 1939, primarily doing work for the privately owned business owner, for the privately owned business. The purposes can be a lot of different purposes. We're most well known in gift and estate tax valuation work. So there could be the doing work for the business owner and his operating company over the last 30 years or so. We've moved into valuing a lot of other asset holding companies. You may be familiar with family limited partnerships or family LLCs that hold marketable securities or real estate. We're still doing a lot of those. As a part of an estate plan or upon the death of a high net worth individual. We're headquartered in New Jersey. although we have offices, several offices on the East Coast as well as the West Coast, and we have a Chicago office as well. So we are nationally known. We go anywhere. It doesn't really matter, especially in these days of Zoom webinars and things like that. That's a little bit about us. This slide just gets into some of the different purposes. The top block there, that is what we're most well known for. Like I said, gift, estate, and income tax, some other corporate planning, ESOP valuations. I don't know if we have any ESOP-owned companies here, but we do a number of ESOP valuations on an annual basis. Then we get involved in litigation. So that could be damage calculations, or you may have shareholder disputes, family disputes, and then of course, divorce, matrimonial divorce as well. On the corporate advisory and M&A services, we will work with the business owner to help them figure out what the next step is. And that typically starts with evaluation. And we can talk about the potential buyers in their industry. Is private equity an option? Is it just strategics? We can talk about the differences in value and help point the business owner in the right direction. And then finally, we get involved in financial reporting valuations. We're typically hired by an audit firm here to do a purchase price allocation after the business makes an acquisition. We get involved in equity-based incentive compensation, as well as for private equity firms. We can handle the portfolio company valuations as well. So that just gives you a little flavor for the different purposes for our valuation work. This is always a fun slide to talk about, and maybe this will help generate some questions for you. But I'd just like to go through some of the more interesting assignments that we've done recently. We did a rather large restaurant group. It unfortunately, the project started right before COVID, and the transaction date actually moved to post-COVID, which for this particular restaurant company was very interesting. They lost about half of their stores, or restaurants. So the pre and post-COVID valuation was significantly different. So just that's some of the things that you do have to consider is the future earning power of the business. And if those, you lose half of your business or a good chunk of your business, then that's something that needs to be considered. The second one here, we're doing some work right now for a regional grocery store chain. There's actually two different engagements. One is for estate planning purposes, like I described earlier. And then we're also going to help the main owner is going through a divorce. So we will likely be their expert witness as well for that. The third bullet point is something else that we've actually seen a lot. We've been doing a lot more work for charitable contribution purposes. The M&A markets have been rather hot here in the last couple of years, obviously depending on what industry you're in. But we'll get calls, where perhaps they didn't do a ton of estate planning, moving assets out of the estate while the company was just a normal going concern. But if they start to enter into discussions with a potential buyer, they can make a charitable contribution of the stock to could be a foundation or some other charitable organization. And there we're actually, the client is typically interested in the higher value because you get the larger income tax deduction. So we've been doing a lot of those, and depending on how close they are to closing the deal, more often than not, we wind up pretty close to what the deal value would be, which is beneficial to the client, from a tax deduction standpoint. The fourth bullet point there, this is another interesting one. We had a ready-mix concrete company that we were doing some work for. An engineering firm that was doing work for them did a major miscalculation. with one of their machines. They the calculation was they literally moved the decimal point one time, and it led to not so much an explosion, but it really ruined a major piece of equipment and put this company out of business for a pretty significant amount of time. And we were doing a lost profits analysis for a litigation that they were going through. The fifth one I always like to get in there, that's a practice I helped develop here at MPI. We do a number of professional sports teams on an annual basis. Most of those are for either estate planning or estate tax purposes, and professional meaning, the 4 major sports as well as some of the MLS teams. And then occasionally we get involved in some minor league teams as well. And then the last one down there at the bottom, we did some work that went on for a very long time for a matrimonial dispute. We had to do both some valuation as well as some forensic work to get an understanding for where funds were actually going in this investment management firm. It was your standard financial management firm. All right, so I'm going to move on. These next couple slides are just telling you a little bit about some of the organizations. We really do try to align ourselves with private family-owned businesses. That's most of the work that we do, and we enjoy being a part of organizations like this. And again, this just gets into some of the other. A lot of our clients, I would love it if it were more of our clients, but a lot of our clients come back to us on an annual basis. If they're doing annual gifting programs, or if you have incentive stock plans for different executives. Again, ESOPs are obviously, that's an annual thing, as well as some of the other things that are mentioned there. Just multi-generational ownership transfers and charitable planning, big part of what we do as well. So just want to, this is a chart that I'm sure many of you have seen something like this in the past. This gets to the different levels of value. So, when I get a call from a business owner and, they just start talking, hey, I want a valuation of my company. And I say, okay, well, what kind of valuation are you actually looking for? Because there's big differences. You're in an estate planning situation, more often than not, there's either a gift or some transfer of at the very bottom there, a non-marketable minority interest in the company. This is where you can take the most levels of discounting. All right. And typically when you're doing an estate planning transfer, the lower the value, the better, for obvious reasons. You're using less of your estate tax exemption during the lifetime, so you can move more company stock at a lower value. So that's the lowest value there. Up at the top, that's your strategic control value, and we're going to talk a little bit about this later when I talk about exit planning. But your strategic control value, that is where you find a buyer that has a perfect little niche. You are the little niche that they don't have, your business. And there they know they can take you, plug you right in, might be able to get rid of some costs and things like that. And that company is more often than not willing to pay the most amount for your company. The next layer down, that's your financial control value. So when we say you have a financial buyer, that's your private equity firm or some other organization that is just a financial buyer. They don't plan on changing a lot with your business more often than not. There might be some things that they can cut out, some back office things, but the amount that they can change probably just isn't all that great. They're interested in your existing revenue, your existing EBITDA. Again, you would still be selling control there, but typically you're not going to get the same price as you would to a strategic buyer, somebody in your industry. And then just going down the list there, then you have marketable minority. What that is you take a discount for what's called lack of control. This would be a minority-based value in your company. So you have a lack of control, which can be pretty significant. You know, here we mentioned 10 to 20%. That's pretty common. And then the next layer, discount down, non-marketable minority. What that is, that's a minority-based value in a privately owned company, which I think is everybody on this call here. There's no market for your stock. If there is, you know, if you're traded on the pink sheets or something like that, typically this discount would be reduced. But absent any sort of active market that's going on, it's pretty common to see a significant discount of 25. You know, here we go to 40%. That's pretty rare, but you know, 20 to 35% discount is pretty common. So you start adding up some of these discounts, your minority, non-marketable values can have a pretty significant discount overall from what your sale merger value or your enterprise value might be. So I always like to get that out there just to, and I'll share this with my clients sometimes because it can get confusing. But you know, the way that I like to explain it is when you go and you buy a share of Microsoft on, you know, just in some online trading account, you are buying a minority-based value in that firm. You're not buying control. So there's already some of that discount is built in. You know, probably that 10 to 20% discount is up there at the top. But obviously with Microsoft, that's an actively traded company. You don't get that big 25 to, here it's listed as a 40% discount for having no market. So that's typically the biggest benefit when you talk about an estate planning transaction, trying to lower value. It's due to the lack of a public market for your company stock. Okay, so let's start talking about estate planning valuations a little bit. So the estate planning process. I'm sure that many of the business owners on the call or the advisors on the call, you know, hopefully you've worked with an estate planning attorney in the past, either with wills or custody or other tax planning things. But more often than not, we get involved after a trust and estate attorney's already been hired, a complex plan for the business owner has been put together, and it's been determined that the privately owned stock of the business or the asset holding company, that is coming up, or that is part of the estate plan. If just marketable securities or cash or you know, pure real estate is going to be used in the plan, you don't need somebody like us. So a lot of times I will get calls from the business owner or the high net worth individual directly. But I always ask, have you already started working with a trust and estate attorney? Because there's no point in going through all the valuation work if the company stock is not going to be part of the plan. So I always encourage, and I'm happy to make those referrals. We work with folks all across the country. I make those kinds of referrals all the time. But generally, you know, point number two, most of the transactions that we get involved in, you're trying to get assets out of the business owner's estate. So, you know, the most common is, you know, there's let's say there's 3 children, perhaps there's a trust for each child, and the estate planning attorney saying, okay, we're going to give away whatever it is, 5% blocks of the company stock to each trust. And we're going to do that every year or every other year, whatever the plan is, until they remove a significant portion from the business owner's estate. And there's various trusts. I'm not going to get into all that. A lot of times we don't even know the entire plan. We've just been told, hey, it's some trust planning work here or some gifting work that's being done. Again, just getting back to what I mentioned on the last slide, point number 3, minority or non-controlling interest are most commonly used in these types of transactions. Now, if you have a relatively small operating company, something that's has a value of less than 10 million, let's say, in theory, you could give away the whole company. A lot of folks aren't interested in just giving away control to their children or some other generation. But sometimes that comes up, and if the value of the company is less than the estate tax exemption, which now is, Pat, you probably know better than I, but 12.5 million or so, somewhere in that range. If it's less than that and you haven't used any of that up, you could give away the entire company. That's a rare case, but more often than not, it's minority non-controlling interest in these kinds of companies. And the reason being is for the next point, which is in bold there. There's a significant discount from the sale, merger, or the enterprise value. 25 to 50% after you take everything into account is not uncommon. More often than not, bullet point number 4, trust and state attorneys like to use assets in these complex transactions that are most likely to appreciate. You want to get those out of the estate. If you have an asset, you own 100 acres somewhere that is just never going to appreciate for whatever reason, or you have some security that is expected to depreciate for whatever reason, those typically are not good candidates. So anyway, that's just a point there. And then, of course, I list number 5. This is an appraisal is really needed when you do a transaction of a private asset where there's no market. If not, I don't know if any of you have filled out a gift tax return before, but I believe there is a checkbox. If you have a private asset, is an appraisal attached to this gift tax form? If not, if you just put a value on there and you do not check that box, the statute of limitations does not begin running. In theory, the IRS could pick this up in 10 years if they wanted to, and they could audit that transaction. That happens on occasion when somebody dies and the IRS starts digging into, some of the previous transactions, and they may see something that a previous transaction that they don't like, and they start asking more questions. If you do that, check that box because you hired somebody like MPI. The 3-year statute of limitations gets running. Once you get out of that, then that transaction is done. Can't be audited again. So that's why even sometimes on relatively small transactions, the trust and estate attorney is always saying, hey, let's get the appraisal. Yes, it's going to cost some money to hire the MPI or whoever, but it's a bit of an insurance policy. So what's going on at the IRS? This is, we come up against the IRS on a regular basis. We will work directly with them if the client and the advisor wants us to. Sometimes we just provide bullet points or things that we can do behind the scenes to allow the advisor to try to settle with the IRS, whether it's at our number. Sometimes the advisor may come off our number a little bit to just get the case settled. But anyway, this is always interesting. We hear some of these things through some of our contacts throughout the country. But in 2021, they did hire 80 new engineers. It's our understanding that there's about 115 gift and estate tax agents right now, with about 70 more that they're trying to hire. The problem with trying to hire so many, it looks like they've the being an attorney requirement is no longer a requirement. Some of the ads that we've seen or our folks have told us about, that only a bachelor's degree is required, which leads to inexperienced agents and engineers, which sometimes is a good thing, sometimes it's a bad thing. There's sometimes where we get involved in an audit and they send us some information, some request about our report, and you can tell they have no idea what they're looking at. And sometimes that's even more difficult to respond to than, an engineer that, is asking relevant questions. And then we say, okay, well, good point, but this is why we think, our position is correct. A lot of times with these inexperienced people, all we're doing is telling them, hey, go to page 40. It tells you exactly what you're asking right there. What we've seen though is that the time for the taxpayer on an audit is actually decreasing a little bit. It seems like they're just trying to churn through these. So if they get involved, they try to settle them a little quicker than in the past. And why exactly that is, the amount of gifting and other estate planning transactions that has occurred over these last 2 years is massive. The number of transactions that we've been involved in, it's crazy. At the beginning of the pandemic, obviously we were worried about business, but since then it's just been through the roof. Doing this work just with all the political pressures in Washington, a lot of people have been doing a lot of planning here in the last couple of years. So the amount of appraisal work that needs to be done, that's on the IRS right now, and they just don't have time to, open something up and, dilly-dally for a year to get through it. They've been trying to, if they do audit something, get through it quicker so that they can get to the next one. And what we've seen is they've been going for more of the low-hanging fruit. And so what does that mean? That means transactions that there's some hair on. The transactions where there's no appraisal, or the transactions where just ridiculous discounts may have been taken. They like to go after those. So that's why we always say, hey, get a good advisor, that's not doing anything out of bounds. Hire the appraisal firm that does a lot of gifting work. There's a lot of different business valuation companies out there. And a lot of us specialize in different things. There's some firms that only do ESOPs. We do focus mostly on gift and estate tax. There's other companies out there that do only 409A valuations, or work only for banks. You have to show experience in dealing with the IRS, because there's certain issues that they pick on, that they don't let go. So anyway, I beat that to a pulp, but experience with the IRS is more important, in our opinion, than having specific industry experience. We get pulled into a lot of different niche companies where we'll get asked, hey, have you ever done work for this type of company? There's only 4 companies of us out there, but have you done any work for us? And we'll say, well, no, we haven't. But we can value a company in any industry. The more important thing is, can you write a good report around it that'll pass muster with the IRS? All right, so I get asked a lot about this, the different audit triggers. And I've already talked about these several times. The large estates and large taxable gifts, if you're making a gift of 15 million bucks, to 3 or 4 kids or trusts, chances are it's going to get looked at. If you have a $500 million estate, chances are it's going to get looked at. How closely? You never know. And what exactly are they going to look at? You don't know that either. But those large estates, large gifts are going to get looked at more often than not. I already talked about the second bullet point, the lack of a qualified appraisal. If you don't have that, you're asking for it. Advisors, if you get an advisor and they say, oh no, you don't need to get, this is a relatively small transaction, they're not putting their client in the best position to get through the transaction. Then, appraisals, this is where I said, if you just start you start taking some crazy discounts, that can't be justified. Or you're applying a ridiculously low multiple, to an EBITDA multiple that can't be supported with data. We tell our employees, hey, if you're ever doing anything, your last kind of decision, if the client's trying to push you in one direction or the other, and I say this to the client all the time, hey, if I have to be up there on the stand in tax court and I can't justify my value or I don't feel comfortable about the value, then we can't do it. And more often than not, they understand that. Of course, you'll get some clients that just want, the lowest possible value, but more often than not, they say, okay, that makes sense to me. The last thing we want is, a bad audit and a bad result. Pre-sale transfers. What that is, again, I referred to that before. You have an operating company that's getting ready to sell. And if you make a large gift, let's say you already signed an LOI and your company is expected to be sold in 2 weeks, and you hire somebody like MPI to come in. You don't tell them that you're in negotiation to sell your company, and we go through and we wind up taking a 30% discount. And then the company sells 2 weeks later. Obviously, I'm using extremes here, but you're not putting yourself in the position to have a successful transaction. The value is much closer to what the potential sale merger value is. You can't take massive discounts because every common stock owner, unless you have a weird capital structure, of course, but every common stock owner enjoys pro rata the sale price. So that obviously has to be considered. So you just got to be careful. Once you start getting into possibly selling the business, you need to make sure all the I's are dotted and the T's are crossed. Pass-through operating companies. This is one area that the IRS does not like to budge on. I don't want to get too far into the weeds, but most appraisal professionals will tax affect the earnings of an S Corp or an LLC and determine the value of the company based on those tax affected earnings, which obviously would reduce the value. But then you have to make an adjustment to the company at the conclusion of your report if there's a real benefit to being an S Corp, based on distributions and other things. All that needs to be considered. The IRS, they do not like that position. They do not like the tax affecting of earnings. Although most appraisers in our industry do tax affect, and there's been a lot of back and forth. But that's one area they don't like to budge on, and we negotiate pretty hard with the IRS on that. Tiered discounting, split dollar life insurance. Those are some other things that are rather specific. I don't want to get too far into those. Formula transfers. You may have heard of this if you've done any planning before you get an appraisal done. A lot of attorneys, and this has happened over the last few years, where you make a gift, let's say whatever today is. Let's say today's July 31st. You make a gift on July 31st. You don't have the appraisal yet from the MPI. And you say, hey, I want to make a gift of $5 million. The number of shares will be determined that are equivalent to $5 million after MPI does the valuation. However, that should be a completed gift if it's been documented correctly. The problem is, and that's called a formula transfer, and there's a few cases out there. One case is called Wandry, W-A-N-D-R-Y. I'm sure many of you are familiar with it. It generally does count as a completed gift as long as everything is documented correctly. So again, that goes back to having the good advisor, the good trust and estate attorney that's willing to do this and has done a formula transfer in the past. Charitable gifts. again, you need a qualified appraisal. That there really isn't much wiggle room. If it's not a marketable security, you need a qualified appraisal. And sometimes, well, I don't want to get too far into it, but just if you, any type of privately owned asset, you need to get it. Sometimes it can be a pretty simple letter that we can do. But we've looked at it, we will sign off on it, and what we would do would be considered a qualified appraisal. The lack of that, you're asking for an audit, unfortunately. All right, so just some of the main issues we see at audit. More often than not, it revolves around discounting. When we take a lack of control discount on an asset-based holding company, they will come after that at some point, although we are very comfortable with how we generate these discounts. We have the data to back it up. A lot of times they will come and just say, oh, well, we don't like that 10% discount or whatever it is. We have the data, we back it up. The discount for lack of marketability is something that almost any agent will go after. I'm dealing with an audit right now. We took about a 28% discount. The IRS came back with an 18% discount for lack of marketability, which sounds like it's really far apart. It really wasn't that far apart. A lot of times they will come back and say something like, oh, well, we'll only give you a 6% discount. They would be using some dated study or some dated case, that doesn't align with the current case. We have our own restricted stock study. It's a living, breathing model. It takes into account the volatility of the public markets on our valuation date. It takes into account what's going on within your industry. And that's what the tax court have been asking for over the years. And now we have a living, breathing model. So every time the IRS comes to us with some of these dated studies, we just, we can fight back pretty easily, because we say, hey, did you take into account the volatility of this of the ready mix industry? And they'd be like, well, no, I see that the study was done in 1995, and there was a discount of 18%. That's what I'm going to rely on. And that just, in our eyes and the tax court eyes, that's not really, that's not the best solution anymore. There are models out there, including one that we have. Voting rights, that's another issue that comes up. If you're talking about a minority interest in a company and you have voting control, or if you just have a vote, you don't have control, versus a non-voting stock, the difference is actually pretty minimal. You still don't have control, but they do like to latch onto that. They do like to latch onto that for some reason. And more often than not, you just have to explain to them what's going on. And then finally, the other thing that we see all the time is tax affecting of S corps. That is an issue that is absolutely relevant. It comes up all the time, but we have good arguments, and we fight them tooth and nail on this issue. All right, Pat, are there any questions in the queue on estate planning valuations at this point?
No, there are none. But I actually have one question that you can answer later if you prefer to do so, but I'm sure that you get asked this question all the time, and that is, how long do valuations take? And I know it makes a difference what the industry is, how good the records are. Is it an operating business? Are you doing a valuation just for a discount, minority discount, or the structure and all of those things? But generally, can you just talk about the timing on starting a valuation and completing a valuation?
Sure. These last couple of years have been extremely busy. So our biggest, the biggest reason for slower turnaround times is just volume at this point. So I'll answer that two ways. I'll answer, pre the past 2 years, and then these past 2 years where it's been absolutely nuts. Right now, for an operating company, and we always start the clock ticking when we receive the information, because that, as I'm sure a lot of you that deal with private businesses, a lot of times that's the hardest part. Being an advisor is getting good information from the client that we can work with. So I'm always very specific. Hey, the clock starts ticking when you get us the information, because we could be hired and we don't get the information for a month. So right now, from when we get the information, we're saying we need about 90 days to turn numbers around for the client. And during that process, we're doing the financial analysis. We need a due diligence meeting with the business owners or management to learn about the company. That's usually a 2 to 3 hour meeting. And then, we go through our partner review process and all the other things that we do. But right now, for an operating company, 90 days to turn around numbers, and then usually another week or two to put together the full written report. More simple projects, like think of an FLP that just owns marketable securities. We can do that pretty quickly. Assuming we get everything quickly and there's no hiccups, usually that's a 30 to 45 day turnaround. So generally that's where we are right now. Now, if there are times where, we'll get a call, somebody dropped the ball, there's an estate tax return due in 30 days, or there could be another purpose. If there's a litigation purpose, and they need something, very quickly, I feel that call. I get on the phone with our different teams. We're about 55 people. So sometimes we can shuffle some things around to try to squeeze things in. So just because I say 90 days, that's kind of the going rate. But we try to make exceptions for good clients, good referral sources, if we can.
Yeah.
So
Well, that makes sense. That's much faster than I would have thought. So that's very, very helpful. So I'll let you go on with exit planning valuations.
Great. All right. So you've gone through the estate planning. You've worked with a trust and estate attorney, business owners getting up there in age. Maybe there's not, maybe the next generation is not interested in working at the company anymore. Maybe there isn't a next generation. Start thinking about, all right, what's next? Sometimes we'll get calls. Hey, I'm thinking about just shutting down my business. And it's always like, whoa, hang on. Maybe, there could be some value here. Even for a very small business, company that produces something, maybe you can find a buyer out there that, would fit in there perfectly, fit in their portfolio perfectly. So, this is put together. We have an M&A team at MPI that works with business owners. And again, I'm happy to share these slides, but it's just kind of, if you're an advisor to a business owner, this is kind of a good framework to start thinking about what you need to do. What's the business? You got to start with what does the business owner really want to do? Are they ready? A lot of times getting to retirement, especially for an entrepreneur that's been working for 40 or 50 years, a lot of times there's no point in going through this whole process if you're going to get to the 10-yard line and then they just decide to pull the plug. No, I'm not ready. So that's the first point. It's just understanding what the business owner really wants to do. Then you got to put a team of advisors together. And this, this is a process. I'm sure you've all heard this, but it's not a simple process, and it can be a rather costly process. Typically, you're going to need you're going to have to involve your CPA. If you don't have the right CPA, you're going to need to get your books in order, because a lot of times that's the first thing that a potential buyer sees. And if you're just dealing with QuickBooks or something like that, you're not putting yourself in a great position. You just, you need to have your financials in good order. Then you're going to need a tax attorney. So probably that may or may not be your trust and estate person. More often than not, it could be somebody else. And then you're going to need a corporate attorney that has the ability to put together purchase and sale agreements and things like that. And then at some point, you're going to need an investment banker or a business broker, depending on the size of your business. Then the next few things are things that you just need to be in order. Human capital. Do you have backups at the right positions? Do you have any potential major lawsuits that are outstanding? All that needs to be cleaned up as much as possible before you start to go through this process. Then you need to really understand what's the drivers of value in your industry. Are you the upper echelon within your industry? And then you need to start thinking about the buyers, and that's where firms like us can help with. There's some industries where financial buyers, meaning private equity, they just have no interest. So are you only a strategic, is the buyer only a strategic buyer? We can help identify those buyers, hopefully get a good sense for the type of multiples that they may have paid for companies like you. And then finally, you need to talk it through with the business owner. All right, what will the sale process actually look like? Are you really looking to do a full auction? Meaning, take the company to market, identify 5-10 buyers, and then it comes down to who is the highest bidder or who's the best fit. All that needs to be figured out. Some business owners say, hey, I have a competitor. He's a good guy. We are competitors, but we both operate the same. Can you just deal with him? And certainly we can. You can just go to them and talk about, come with our valuation and try to negotiate that way. You can. Typically, that's not going to necessarily lead to the highest price, but sometimes that's all the business owners is interested in, is smooth transition, and not dealing with the hectic process of the full sale of the company. This gets to some of the things I just mentioned on the previous slide. Some business owners might not be willing to sell the entire business, so maybe they only want to sell 49%. Keep control, continue to operate the way they want, but they want to take some chips off the table. That's fine. You're not going to get maximum price. Some guys want to sell 60%, where they still want to, and a lot of financial buyers, they're interested in buying 60% or 70%, keeping the existing management on with a vested interest, with that remaining 30 or 40%, so that they continue to run the company at maximum profitability. That happens very frequently as well. So most of the other things we've pretty much mentioned, and I will continue to talk about. Sorry about that. Okay, and I'm wrapping up here real quick. But this is just a little chart here about the different potential buyers. I'll just go real quick. Again, large strategic. That strategic buyer, you'll hear it all the time. That's somebody in your industry that would love to gobble you up. They can probably cut some costs. They can do some other things, and they may be more desperate to find a company like yours, and they may be willing to pay a little bit more for it. Private equity or financial buyer, they can get deals done. There's plenty of money out there, but more often than not, they're not going to overpay. They don't necessarily need your company to fit perfectly into their portfolio. Sometimes that might be the case, but with a private equity firm, typically that's not the case. So you're going to get the next value down from a strategic buyer. The next thing here is management. A lot of times we'll get calls, hey, I'm interested in selling to management. Okay, that's great. They know everything about the business. Maybe they've seen the financials. Obviously, they're friendly. Well, most of the time they're friendly. But what are the big challenges? Do they have any money? If you're dealing with a guy that makes $100 grand a year or has made $100 grand a year, can they really afford it? Probably not. So that's something that you're likely going to have to take a pretty big discount for that to even make any sense. Or an ESOP. ESOP is less popular, today than it was maybe 25 years ago. But in the right situations, that can be an interesting transaction. There's some tax benefits there. Sometimes the business owner can stay in control. If they sell control, there needs to be, there's a trust that's involved, and there should be separate trustees involved. The problem with ESOPs, you're not necessarily going to get the highest price, and there's costs. There's maintenance costs during the life of the ESOP. And it just there's a lot of burdens involved. We've had situations where the Department of Labor has gotten involved because the ESOP wasn't being run appropriately, or it wasn't being run the right way. So there's just a lot of administrative problems, potential problems with an ESOP. So anyway, that is. That's potential buyers. Here real quick, I've talked about this throughout, but the difference between the minority value and the sale merger value, a lot of it has to do with what we call add backs. If you have a current business owner that takes out $5 million of W-2 comp to reduce taxable profits, but a potential buyer wouldn't necessarily have to pay a CEO $5 million. Maybe they would pay $500,000. You might make that add back of $4.5 million back to the cash flow, which obviously is going to increase the value of the company. Other cost savings, eliminating back office, duplicative operations. Perhaps there could be some pricing differences with your product. With the new company versus your existing company. There's things like that all need to be considered when you're talking about a sale merger value versus a minority value, where you don't have the ability to make any of those changes. And then of course your marketability discount is probably it's typically the biggest reason why minority versus sale merger value are so different. And then of course, we look at transactions within your industries. A lot of times you're going to see richer multiples for 100% controlling interest versus a minority interest in that company. So, we look at everything. All right. So that, was just kind of a quick overview of the exit planning process. This here, I just like to include, this kind of gets to, what's asked of me a lot, getting back to Pat's question of timing. This is how it typically works. I get a call, I scope out the project. I ask a lot of questions up front because whenever we can, we like to quote a fixed fee. We try not to be like attorneys and work hourly. We do 1,000 valuations a year, so we know typically how long it's going to take. So we can quote fixed fees more often than not. Then you have your engagement letter that goes out. We ask for information. Once we get that information, like I said before, the clock gets ticking. We do, our initial modeling, industry research. Then we'll have our due diligence meeting with the client to learn more about the industry, learn about the internal and external issues that really affect how the company operates, both positively and negatively. That's a big part of the valuation process. Then we finalize our models. We always share everything in draft form so that we can get feedback from the client. We are not one of those shops that will issue numbers and say, we are right all the time. We're not interested in hearing feedback from you, because you may not realize, what we think about. We will issue our work papers, explain how we got there, and they're like, wow, you know what? I totally forgot to tell you about this situation. Does that affect value? We'll say, yeah, it really could. So we try to be easy to work with in that regard. And then finally, once we all agree to the numbers, we issue a report in draft form so that the advisors can look at it as well. And again, we take feedback on the written document. But again, that written document, especially for estate planning, will meet IRS muster. But we're always looking for feedback to tighten it up.
I will just say, wrapping up, thank you so much for doing this presentation today. And I would just like to tell people on the call that I personally used MPI. It's an excellent firm. They do excellent work. I think they are very timely in delivering their work product, which I think is really good. And I think they ask all the right questions. So Mark, really appreciate you being on the call. Really appreciate you delivering the presentation today. And we hope everyone has a great rest of your day. Take care. Bye-bye.
Thanks.